We're live. I'm Tyler Stanley with the Stanley Group and Keller Williams Realty. Ben Bell is here with the Bell Mortgage team of Homebridge Financial. So this is the first episode of State of the Market. What we're going to talk about today is mortgage interest rates. Ben's going to kind of walk us through how the Fed rate, when the Fed raises their rate, from the basics of what the Fed fund rate is, and that all the way up to when they increase that rate, how that affects mortgage interest rates. Because, the general consensus is when they raise the fund rate, that mortgage interest rates go up as well. But what we found out, 2 weeks ago, is that it doesn't always go up when the Fed rate raises it up, right?
That's 100% true. March of 2020, the Federal Reserve dropped their Fed fund rate to 0. And the phone calls came in and they're like, hey, Ben, our mortgage rate's 0. We're like, no, not even close to 0. But so the Fed fund rate is short-term rate. I mean, it does not affect mortgage rates how you would think. So like even 2 weeks ago when the Federal Reserve came out and said, hey, we're going to raise the federal fund rate. Well, mortgage rates went up a little bit, but then they've gone down since. And the mortgage rates, the Federal Reserve does have an impact on interest rates, mortgage interest rates, because of some of their monetary policies. So like when the Federal Reserve buys government bonds, treasuries, that helps out mortgage interest rates. We saw that again in 2020 because the Federal Reserve stepped in and they started buying a ton, billions and billions and billions of dollars a day of mortgage-backed securities, which helped out the 10-year treasury where mortgage-backed securities are tied to and follow. And that's what drove down that 10-year bond. So that 10-year bond got down to like 0.4, like 40 basis points. Okay. And that was the story the past couple of years, and then we started seeing that 10-year starting to creep back up to where we are now because, and I will tell you, mortgage interest rates and inflation are enemies. So anytime inflation goes up, mortgage interest rates go up because what inflation does, it makes the dollar so cheap. Okay. Nobody wants it. So it trades higher. Nobody has an appetite for cheap money. That's why interest rates get driven up. So an appetite for investors as well.
Okay. Gotcha. So where are we this week? Where are you seeing what's going on with mortgage interest rates?
Past 2 days have been great. Right now, I think I can share the screen here. So
All
you
right.
can see, this is the 10-year treasury right here. This is all the way from right on top, on the top left, you'll see this was 2019 and we're hit bottom was in March of 2020. Okay. Ever since then, all of 2020, we had a really good, 10-year treasury. Interest rates were super low. This is when we were locking people in the, high twos on the 30, mid to high twos on the 30-year fixed rate mortgage, which is just unheard of, lowest ever. And then, we had a little bit of a spike and then it kind of leveled out again in 2021. Well, the start of 2022 is when the Federal Reserve came out and say, okay, we're gonna start raising our federal fund rate. We're also gonna stop. We're gonna they're gonna start selling off their balance sheet as well. So all those mortgage-backed securities that they've been buying, well, they're gonna start selling those off. Okay, so you can see really what happened to interest rates this year. It went straight up.
Mm-hmm.
Just from pretty much the language and what they plan to do this year as far as their federal fund rate.
Gotcha.
So as far as interest rates go, I personally and what I've been hearing and reading, they're just trying to find some footing. I mean, interest rates are just trying to find some solid ground. There's just been so much volatility. We're having good days and bad days. Mm-hmm. And we have not had a consistent, steady run of just a flat footing for anything. And the Fed's going to meet again in June. They're going to hike their federal fund rate again, 50 basis points, maybe 75. It all depends. They're really, really trying their hardest to ease that inflation.
Mm-hmm.
Once they ease that inflation, once the Federal Reserve eases the inflation, which is the arch enemy of mortgage-backed securities, mortgage rates will come down. How long is that going to take?
Right.
I don't know.
Is it years possibly, right?
It could be. I personally think they'll get like 2 or 3 more rate hikes in.
So you think that where we are with interest rates right now, that the next hikes are not going to affect where it is right now? Okay.
I believe they're already priced in.
Where do you see interest rates going in the next by the end of the year?
I think we'll stay close to where we're at right now, but I really do believe something's going to have to happen to ease this inflation. I don't know if it's going to be a recession. I don't know if they can keep on doing what they're doing and do a soft landing. I don't know if it's possible. I really don't. And I don't think anybody knows, to be honest with you.
Gotcha.
Whatever they do, they have to get that inflation under control.
Yeah.
And then mortgage interest rates will come back down. They always, if you look at the charts, anytime that inflation's been out of control, mortgage interest rates have also been high, but they always return to their lowest level or close to their lowest level.
So you seeing like clients slowing down with shopping because of the interest rates going up?
There is a part of the population that can't buy right now. They're priced out of the market with the current environment.
Yeah, absolutely. I mean, I've definitely seen that from buyers that I've talked to, that, some price points, it doesn't matter as much, but on the, lower price points, they're just out of the market at this point until they can, save some more money or maybe interest rates go back down.
It's demand right now. I mean, unfortunately, those people are just out of the buying pool, but guess what? There's still so many buyers behind them who can buy. And that's what really hurts some of those buyers, because hopefully homes continue to appreciate, which I think they will. I don't think they're going to continue to appreciate at the pace that they have been. I think that also needs to normalize with the interest rates need to normalize as well, because, I mean, we're almost at I don't think we're almost. I think we're at, you could speak on this as well, as, affordability issue. Yeah,
that's absolutely right. I mean, we're, I'm seeing that in the market, absolutely is that, affordability issues. So like I said, some buyers are being taken out of the market, which is causing a little bit of slowdown. We're definitely seeing that, and we're seeing still some hesitation of folks to sell because they don't know where they would go if they would sell. That's the question, is where would I go if I sell?
Maybe it's working what the Federal Reserve's doing. I'm still hesitant to see what's going to happen with the next couple of rate hikes.
Yeah.
But they have to get it under control. I mean, There's no way around it. And, we were in a really good place in 2019. We were, 17, 18 were not good. Inflation was high. Interest rates were high. January or February of 2019, and interest rates he was in the high 4s on a 20-year fixed rate mortgage at that time. So that's, that was pretty high at that. And then,
and then they dropped off. Yeah, I remember.
It did drop off. And 19 was a really good year. I felt like it was a balanced all across. You didn't have a ton of movement. Everything was kind of in that high 3, mid 4 all throughout the whole year. Pandemic hit, boom, and then we kind of did this to ourselves. We did. I mean, you had to do what you had to do to keep the economy going through 2020 with how much money they were printing, stimulus packages, what they were buying in mortgage-backed securities every day. It's just, there's no way around what we're dealing with right now. It's just, and I personally, and I hate to be a Debbie Downer, I don't know what they're going to do. And I don't know if there's a soft landing. I really don't.
Yeah. It seems like there probably won't be a super soft landing.
But that doesn't mean if we have a recession that home values are going to decrease.
Yeah.
Let's get that straight, because that doesn't mean recession doesn't mean home values are going to decrease. That only happened one time in the past, like I think 5 recessions. I think I saw a chart last 5 recessions. Home values only decreased one time, and well, that's because we caused, the big, whoever caused it, the housing crash. That's what caused the recession.
Yeah, because it was the cause of the recession. Yeah, absolutely. And I mean, houses right now, houses are in such high demand, with there only being, a month of inventory, a month of supply on the market. Houses are still in such high demand that we have a long way to go before we don't see that kind of demand, because people are going to move, no matter what. People have to move around, and if there's just nothing out there for them to buy, that's going to keep demand up. Once again, thank you, Ben, so much for coming on.
Yeah, man. Appreciate you.
And then this was the first full episode, especially using this new technology that we're trying to figure out. So brand new to me anyway. So next time, hopefully less glitches on the next one. So
Tyler, appreciate you. See you next Thursday.
All right. Thanks, Ben. Talk to you soon, man.